Let us look at the likely drawbacks, disadvantages, or the pitfalls of margin trading. Margin trading essentially has to do with trading on margin. That is, you have your stocks with a broker, and your broker will then lend you money, all right, to to buy additional number of shares. So you are trading on margin. It's like collecting loan from your broker to buy shares. So you want to highlight the risk involved. Number one is increased risk of losses. Actually, is there's that tendency you could incur losses. And the most significant, downside of margin trading is that it amplifies your losses. If you make gains, it amplifies the gains. If you sustain losses, it equally amplifies the losses. So if the value of the asset declines, you could lose more than your initial investment, as you still owe, your borrower, or as you still owe your lender, funds, money you borrowed from the broker, as the case may be. So when you incur losses, you still have to pay up whenever the margin calls come. So it kind of increases your risk of losses. Number two is what is called margin call. That dreaded margin call. The matter is that your broker stands to gain. When you make money, he gains. Even when you lose money, your broker still stands to gain. That's one, should I say, funny or interesting thing about margin trading. The brokers are just there to just make money off you. Your misfortune, they'll still make money from it. Your profits, they will equally still make money from it. So if your account, equity falls below what is called a maintenance margin, your broker will issue a margin call, requiring you to either deposit more funds or sell securities to restore, the required balance. So, failing to meet the call could lead to forced liquidation. What happened here is that this is what you call a maintenance margin. All right. Let's say the maintenance margin is maybe $100,000. If the equity in your account goes below 100,000, let's say it goes to maybe $80,000, you receive a margin call to make up the $20,000 you need to bring your equity to $100,000. So that was called margin call. They call you, our client, the value of your portfolio has gone below the maintenance level. Please, deposit this amount of money to be able to balance up. And you just have to go and look for the money and balance. If you don't balance that money, they'll be forced to do what? To sell your shares to recover the money, to make up for that particular shortfall. Number three is interest cost. Borrowing money to trade, incurs interest charge on the borrowed amount. And then this cost can accumulate over time and eat into profit, especially if the positions are held for a long period. My broker, sent an email, regarding the margin facilities they offer. And I look at the document, I discover that I will need to pay in a particular amount of money monthly, not just when I eventually sell the stocks or silver, but I have to put in this money, pay this interest, on a monthly basis. And when it comes to paying interest monthly, it's never really a good idea as a trader, as an investor. Whether you make money or not, whether you sell the shares or not, you are expected to do work to keep on paying this money monthly. I say, Kai, I don't like the idea. I am not very comfortable with the idea, actually. So that is, a very important drawback of margin trading. The increased cost. You are getting this money at an interest, and that interest is paid monthly. Assume it is paid when you sell the stock, fine. Whether you sell or you don't sell, they demand this interest to be paid on a monthly basis. So it's not all that palatable. Number 4 is the potentials for forced liquidation. When the margin calls come in and you cannot meet up, you'll be forced to do what? To liquidate your position, to sell your shares so that they can so they can recover their, the money you borrowed from them, potentially leading to what? Leading to a huge loss. That's why, traders used to blow their accounts. It's because of what? They trade, on margin. All right. They trade on margin. So you keep on hearing stories of traders, blowing their accounts because of the margin facilities their brokers give them. And so once their stock is almost like the equity is like eating once the loss is about, is eating part of their own capital, then the broker will force to act. Before it touches your own capital, they've sold your holding, and then your account is blown. Number 5 is emotional stress. The amplified risk of margin trading, can cause emotional stress. You cannot sleep well at night. You are expecting that dreaded margin calls. It's not something, it's not for the novice, So you might end up, selling, end up selling as a result of panic selling, and that may involve you selling at a loss, just kind of impulsive decision making. Number 6 is over leveraging. There's a tendency you could over leverage your account. That is, you can borrow more than you need to borrow. So using margin increases the potential of over leveraging, where investors take more risk than they can afford. Over leveraging can lead to rapid losses if the market goes against your position. You borrow so much that if the market drops, then you are in trouble, because you are over leveraged. Let's say your own capital is just maybe 40%. Then the remaining 60% is borrowed. If the market drops, you could imagine the kind of risk you are exposing yourself to. So over leveraging is a delicate disadvantage that one should look into. Number 7 is additional fees. Beyond interest charges, brokers may impose other fees on the margin accounts, including maintenance fees, transaction fees, or higher commission for margin calls. Different kind of fees you could be asked to pay, and this will do what? This will add to your overall cost as a trader or as an investor, as the case may be. So there's that that peculiarity that you could incur a higher than normal level of fees. Number 8 is complexity. It's not all that straightforward. It's a kind of complicated procedure. You have to sign a contract. So margin trading is more complex than traditional investing. Definitely, it requires a solid understanding of how leverage or borrowing works. So margin requirements as well as interest rates and then the risk involved, making it completely unsuitable for experienced investor. I've been investing for the past 18 years. And when I look at the terms and conditions of margin trading, the document they send, I say, this one is not for me. I've not really I've never done that. I've not done that before. And I don't think I will do it now. Although it's fascinating actually to amplify your gains, but don't forget the cost implication, the drawback, that is involved. Number 9 is market volatility risk. The market is always volatile. In a volatile market, margin trading can lead to rapid, unpredictable losses. You felt that the stocks could go up so you can make profit, but instead, in a typical bear market, stock prices will then drop, and that will affect your portfolio. You will start getting, margin calls. So sudden market swing can quickly wipe out your equity, especially if your position is over leveraged. let's say you are, let's take for instance, maybe you are, maybe you in the entire portfolio, 40% of the capital is yours, and 60% is from the broker. So in the case of a market drop, you discover that you may stand to lose. Assuming it is maybe you own 80% and your broker gives you 20%, is a bit tolerable, it's palatable. But in a case where the borrowing is skewed against you, in other words, you are over leveraged, then any market volatility that goes against you will certainly affect you. It will result in losses. Number 10 is risk of falling below minimum equity. Risk of falling below minimum equity. So if the value of your investment drops and your account's equity falls below the broker's required minimum, it may be difficult to restore the balance without significant additional capital. Once your equity drops, you'll be asked to do what? To put in more capital. All right. That is let me explain a bit further. Let's take for instance, your portfolio is worth $100,000. Okay, and out of this $100,000, let's say maybe 70% is yours. That's a very good scenario. 70% is yours, and 30% is for your broker. All right. If the losses there goes beyond 30%, that means kind of your broker's part of the something is gone. You'll be asked to do what? To add up additional capital, or you'll be forced to sell your holding so that your broker can recover the money they gave you. That's how it works. They want to recover their money. So margin trading, offers the potential for higher profit, but can also, magnify your losses. You can significantly increase your risk. It's essential to have a clear strategy when it comes to risk management, on how to be able to handle, margin calls, or to be able to handle margin, in its actual sense. So you don't just rush into it. It needs experience. It needs a kind of oversized risk appetite, because there's always a potential for substantial losses.